Hello, I'm Ryan Lightfoot-Amanoff of Kepler Trust Intelligence, and welcome to the penultimate presentation of our summer series of webinars. Presenting today will be Julian Bishop of the Brunner Investment Trust, an all-weather portfolio of global equities, which looks to find companies that offer a balance of quality, growth, and value. For those that are new to these presentations, the format will involve a rough 30-minute presentation before handing back for 15 minutes of Q&A. Listeners can submit questions through the Q&A function in WebEx, and we will monitor and collate these as we go along and put them to Julian at the end. For the best experience, we would advise using the WebEx app. It's the best way of seeing the presentation and doing Q&A rather than watching in the browser. So without any further ado, I'd like to hand over to Julian.
All right, Ryan, thank you very much, and hello everyone. Big welcome from my side. So today, just a brief introduction to the trust. We'll talk about some of our holdings in a little bit of detail. Talk about how we work, who we are. Apologies for anyone who attends these events that I do regularly. You'll have probably seen and heard some of this before, so apologies for any repetition. But it's probable that we have some newcomers as well, and always want to make sure that they are addressed. So a little bit about the Brunner Investment Trust. So Brunner is a family name. The Brunner Investment Trust was formed in 1927, so almost 100 years ago, after Sir John Brunner, here on the right, sold his chemicals business, and it was one of the four businesses that came together to form ICI, if you remember them, back at that time. And then the proceeds were taken, and a family wealth vehicle was established. And the Brunner family today still own about 30% of the trust, so they view it as a way to manage their intergenerational wealth, and we view it very much with that same goal in mind. We're about 600 million sterling in assets under management today. Like Ryan said, it's an all-weather global equity portfolio that focuses on balancing quality, value, and growth. So we don't really have an ideological straitjacket. We're just always focused on cash, and we'll talk a bit more about that in the coming slides. We have an over 50-year record of increasing the dividend every year and increasing the dividend way ahead of inflation. So that's one of the longest records in the investment trust universe. We're an AIC dividend hero. And another one of the features of investment trusts is that we can retain some of the income that the trust receives in dividends from the companies that we hold, and we can hold that back and pay them out in leaner times. So at the moment, we have well over a year in that reserve, which means that if there is a natural dip in the dividend because of a macro event, for example, we can easily cover that and continue that record. There's a team of four managers, two leads, two deputies, and one of the co-leads. Together 100 years of experience, so four very experienced investors who've seen multiple cycles, different markets, etc., different styles come in and out of favor. Our benchmark is slightly unusual, so it's 70% global, but actually 30% UK as well. And I think at the moment that makes particular sense. There's a huge gap in transatlantic valuations, so it probably does make sense at this point in time to have a bit of a skew to Europe, and in our case, the UK in particular. And we can touch on the valuation disparities that exist globally, but at the moment, certainly in 2025, it feels like there's a world of difference between valuations in the US in some areas and in Europe. And then, last year we were very pleased to be declared the winner in the global category in the Investment Company of the Year awards. So that was very, very pleasing, and that's a great testament to long-term performance on a risk-adjusted basis, plus everyone involved here on the marketing side, on the secretarial side, etc. So just pinging ahead. Here's the team. So I manage the trust alongside a chap called Christian Schneider, who is the head of the global growth team here at Allianz Global Investors, which is employed by the board to manage the Brunner Trust. A couple of deputies as well as Simon Gergel, Simon Gurgle is well known in the UK value area. He manages one of Alliance's sister trusts called the Merchants Trust, which is a UK value trust. So he's very helpful, particularly on the UK side. And then James Ashworth as well, who I've worked with for a long time, ferociously bright, intellectually curious individual who's a great asset to the team. And you'll notice here that we have different sort of slight differences in our approach. So James and Christian are on the global growth team. I sort of participate in the global growth team, also involved in a global dividend fund. Simon, more of a value guy. So the idea is that we have this as eclectic collection of voices that tries to find the best ideas sort of across the quality, value, and growth spectrum. We're part of a big firm, so we have lots of resources at our disposal, lots of internal analysts, for example, who we can consult. So it's not just the four of us. We're very well assisted by a large and able team. Mentioned this earlier. For some investors, they'll describe themselves as quality investors, only looking for high quality companies. Some people will describe themselves as growth investors, only looking for rapidly growing companies. Some people will describe themselves as value investors, only looking for notionally cheap companies. We believe that that's a little bit misguided just to pigeonhole yourself in those ways. So obviously there's a trade-off between these things. So a high quality growth company is likely to trade at a very high valuation, etc. And some value investments lack any quality or any growth, which makes you question whether their value at all. So we really see it as our job to triangulate between these three different competing factors and come up with the optimal balance. The one constant is the focus on cash flow. So we're very centered on thinking about the cash flow that's available for each of our investments and available to return to us as shareholders. Very much focused on the long-term sustainable competitive advantages. So businesses that do something that means that they're resistant to the forces of competition. And when I think back to sort of doing economics A level, one of the first classes you have is on supply and demand, and you have this concept of new entrants. So where there's a lot of demand, you get new entrants. They come in, they erode supernormal profits, and really that's what exists as a check and a balance on the profitability of most companies. But there are a few, not huge numbers, but there are some companies that over time develop sustainable competitive advantages. That just means that they're more resistant to those forces of competition than most, and we think that that's absolutely critical. So when we look at the portfolio, there's a lot of our businesses that either exist in de facto monopolies, duopolies, etc. And we put a lot of emphasis on that when we're doing our analysis. Now the sort of the counter to that is that just because a business is good quality doesn't mean that it's worth an infinite amount of money. So there has to be a sort of line at which you find a balance, and we're constantly looking to do that. And essentially what we're trying to do is buy good businesses that represent reliable growing cash flow streams, and we want to buy those cash flow streams at the lowest possible price in a nutshell. So where possible, we do have companies which have decent growth, not always the fastest growth, but steady structural growth is quite often what we're looking for. And when it comes to valuation, we think it's very important to bear in mind that quality and growth are big inputs into that equation. Mere multiples on themselves don't mean that much. It's very important that valuation is considered in the context of these other factors. Mentioned the dividend earlier on, so you can see there the 53-year record going back to 1972. So the green lines here showing years where we've accumulated income into the reserve, and the red years showing when we dipped into them. So the last time we dipped into the reserve was during COVID, when a lot of businesses cut their dividend, not necessarily because they had to, but because it was so uncertain they thought it was prudent to preserve cash, and we would have concurred that that was the right thing to do as well. Track record. So the top line here in light blue shows the Brunner share price. This is over 10 years, going back to 2015. And then the dark blue line is our NAV, and the red line is our benchmark. So share price up about 207% since May the 31st, 2015, versus a benchmark of about 156%. So good outperformance over the long term and over a wide range of market conditions. So one of the things that has been pleasing is that we have been able to use that balance between quality, value, and growth to sort of pivot away from quality when it becomes really, really expensive and dip back into value. And I think that's one of the advantages of this approach. It means that it's a timeless approach. It's not just going to work at one particular point in time. And then hopefully, just by good judgment, by centering ourselves on cash flows over the long term, applying common sense, we can gradually outperform and hopefully can continue to do so. We often think about our investments in the context of an industry life cycle. So if you imagine a business is sort of born, it's born normally as a business plan, as a simple concept. Then if it's successful, it might have a rapid growth phase, and maybe with time it will level off to a sort of steadier growth trajectory. And then ultimately most businesses do mature. And then some go into decline, some go bankrupt, businesses disrupted, businesses are replaced by something better. That happens. The core of Brunner really is what we would describe as steady growers. So these, from an investment standpoint, we think are advantageous because you get your equity return in two ways. So you get a good cash return. So a typical sort of Brunner holding might have a free cash flow yield of 4 to 6%. And the way to think about that is that's like a dividend yield if business chose to return everything it generated after capex. So it might have a cash return of 4 to 6%, plus hopefully it grows a little bit. And as you capitalize that growth, the total return gets into the double digits. And that's what we've delivered historically, and that's what we hope to do in the future. We also augment that core with some faster growing ideas, but they tend to be proven winners, never concept stocks. We have hard and fast rules that we only invest in companies that are free cash flow positive. So we don't want sort of conceptual stocks, but if there are faster growing proven winners, we will pay a little bit more for those equities and participate in those. And the reason we do that is because if you look at stock market history, it's pretty clear that it's very hard to outperform if you don't have exposure to those world-class growth companies. There is a very strong skewness in historical equity returns towards a relatively few number of stocks. So if you think about the US in recent times, if you haven't had shares in the likes of Apple, Microsoft, Amazon, it's been next to impossible to keep up. The same has been the case in Europe with things like ASML, Novo Nordisk, Louis Vuitton, etc. And whilst we have seen a broadening out of stock markets recently, if you look over the very long term, it's very clear that you need to have a process that allows you to hold world-class growth companies. So we do have a portion of the trust there alongside these sort of steadier growers. We're also very happy to participate in more mature businesses. So generally in those companies, you're going to get the bulk of your equity return through cash. So we have a lot of companies in that area which have double-digit free cash flow yields. So you think about banks, energy companies, some more mature retailers, for example, they might well have free cash flow yields, which they can all return to shareholders in excess of 10%. Particularly at this point in time where quality and growth remain very much in fashion, we think it's pretty prudent and a good source of diversification to have some companies, some holdings in that area too. We have this strange benchmark, not strange, but unusual benchmark, which is 30% UK. The UK is replete with stocks that offer those characteristics. So the UK market in general, if you're going to characterize it, is not a growth market, but it does have lots of great cash cows that we can select from. And we think that's an important way to generate equity returns as well. And just to bring this to life now with some examples. These are some of the names that we have that fit into those sort of three categories. So the core would include companies like Admiral, the UK car insurance company, Thermo Fisher Scientific. It's one of the biggest suppliers to pharmaceutical companies, laboratories around the world. AJ Gallagher is an insurance broker. RELX, information services for e.g. Legal firms. GE Aerospace. GE Aerospace is the largest jet engine company in the world. So we have names like that, Intercontinental Hotels, Visa, and we'll talk about some of these names a little bit more in a minute. AENA, they own every airport in Spain, freehold. So a good mix of different companies from different sectors that all generate lots of cash, return it, and grow at a decent pace as well. On the rapid growth side, we have Microsoft. That's the largest holding in the trust at the moment. So they have two core businesses, really. They have Office. So if you're ever on Teams, PowerPoint, Excel, Word, Outlook, you're one of 400 million subscribers to the Office suite globally. They've seen terrific growth in both users and in price as people move up the price tiers to get ever more functionality. They introduce new functionality, like Teams is a great example, which has exploded in usage in recent times. So that's a great business, effectively no competition, one of the world's stickiest businesses. It's a great annuity-like characteristics. And they also have Azure, which is the leading cloud computing provider. So that's one example there. In semiconductors, ASML, Taiwan Semi, two of the great monopolists effectively in global semiconductors. ASML make lithography machines. These are some of the most complex machines on Earth that are used to make the most advanced semiconductors. So the chip in your iPhone, an NVIDIA GPU, for example, they will all be made using ASML at some part of the process, and they will almost certainly as well be made by Taiwan Semi. So Taiwan Semi is what's called a foundry. This is the company that manufactures the semiconductors, but they operate machines from ASML. In both instances, at the cutting edge of semiconductors, they have close to 100% market share. So as that industry grows, they make great profits and they participate in that growth. And then on the mature cash cow side, just a couple of examples here, which I think are pretty easy to understand. Bank of Ireland, that's what it says on the tin. They when we bought it, we calculated that they could return cash equivalent to 40% of their market cap, so 40 in 3 years. So huge amounts of cash. Most banks around Europe have been completely recapitalized since the financial crisis and have only recently resumed paying dividends now that recapitalization process is complete. But the amount of cash that these businesses are currently generating is truly stunning. Tesco will comment upon it in a minute. Total Energy is a French energy company, and at current commodity prices, generating a free cash flow yield that's well into the double digits. So those are some examples. Now we talked a little bit about the importance of sustainable competitive advantages earlier, and we thought it'd be helpful to sort of talk about one specific source of competitive advantages, and the one we've chosen is network effects. So think about a net, literally lots of different points all joined together. The original network, I guess, was the telephone network. And a good way to think about this, it's a network becomes more powerful the more people use it. So the more people have telephones, the more people can receive calls, make calls, it becomes a more useful tool. And there are examples of privately held networks that we can invest in, and we choose to do so, because once they exist, they become very, very powerful, repelling competition. So we've got three examples here from three continents. Visa in the States, Auto Trader here in the UK, the used car website, and in Australia, a company called Brambles, which is altogether more obscure. But we'll talk a little bit in brief about what each of those companies does. So Visa, you almost certainly have a Visa payment card in your network, sorry, in your wallet. They operate a payment network, so they don't offer credit, they don't issue the cards. Those are issued by banks. They operate the rails upon which all these payments are made. And between them and MasterCard, they have about 90% market share outside of China. So effectively, it's a duopoly. And they take a very, very small percentage fee of every credit card transaction they process, and they literally process trillions of dollars in transactions a year, thousands and thousands of transactions per second. And the reason the network is so powerful is that there are, I can't remember the exact number, but I believe it's over 4 billion Visa cards in circulation, or tokens, because increasingly people have these tokenized on their smartphones. So 4 billion cards in circulation, well over 100 million merchants and websites and shops accept those cards. And so there's a clear virtuous circle. The more people who have cards, the more merchants will accept them. The more merchants who accept them, the more need there is to have a card. And in this day and age, in this digital world where cash has become a very low percentage of payment transactions, you will know as well as I do that it's very hard to actually function in an economy without either a Visa or a MasterCard. There are tens of thousands of banks issue these cards. So it's a great network, which is virtually impossible, we think, to breach. It's been quite interesting. We've seen things like PayPal, Apple Pay, Klarna, buy now, pay later. They all depend upon Visa and MasterCard to process their payments. And so they grow every year with growth in expenditure. Inflation is helpful here. So if inflation goes up, the value of the transactions they process grows up. So it's a great inflation-linked revenue stream as well. So that's one of the core holdings in the trust. Has been for a long time. It's been very successful. On the right, Auto Trader. If you have bought a second-hand car in the UK, you almost certainly would have gone to Auto Trader at some part of your consumer journey, as they call it. And because all consumers go there, it means that virtually every second-hand car dealer in the UK pays to list their inventory on that website. So again, they own a marketplace. It's a virtual monopoly. Basically, well over 80% of time spent on automotive websites in the UK is spent on Auto Trader. And what this means is that every year they can charge the second-hand dealers a little bit more. And they add functionalities to the website as well, which makes the dealer's life easier, but it's just an extraordinary market position. It's very, very asset light. So it takes next to no money to run that business. The margins are exceptional. So the margins for Auto Trader are about 70%, 70. So for every pound in revenue and sales that they generate, about 70p of pure profit. So truly one of the world's great businesses, great cash cow, trading at a reasonable valuation, returning that cash and also growing. The third example here is a company called Brambles in Australia. They operate in the glamorous world of wooden pallets. So these are the wooden pallets that businesses use to transport goods around the world, around countries. They're Australian, but their largest market is in the US. And globally, they own about 300 million or 350 million of these wooden pallets. And the great thing about this is it's very dull. It's a low-cost network. And it's a network because if you want to ship your goods to a market on the other side of the United States, for example, you don't want to have to go to the bother of retrieving that pallet. So what happens is at the other end of its journey, that pallet goes into a pool. Brambles will pick it up, or you can drop it off at one of their collection points, and then they'll give it to the next person who wants to rent it, and then send their goods to wherever they need to send them. So I think they have about 150,000 pickup and delivery points around the world. This is a business that is, benefits from scale. So scale begets scale. The bigger you are, the more pickup points you have, the lower costs you have. So it naturally veers towards a monopoly. And Brambles, for example, in the United States, has about 70% of the market share of this pooled pallet network. So it's a mundane little corner of the economy. We often say that value accrues in niches, and this is a good example of one. This business has been around since the Second World War. In fact, it has its origins in the logistics networks in Australia and in the United States that were in place to manage the war effort. And their market dominance has been in place since then. So, quite often these businesses have a great heritage. They've proven over time that they have created a wall to competition that allows them to operate good profitability in perpetuity. And when you marry that with some underlying structural growth, you get a pretty good formula for a decent equity return. A couple of other examples. So GE Aerospace, another example of a company with terrific barriers to entry, but for different reasons here, not network effects per se. So GE Aerospace is essentially what's left of General Electric. So GE at one point, the biggest company in the world, spectacular rise and then fall, had this big financials business that was undercapitalized, and that was exposed in the financial crisis. So in the years since then, the company's been completely restructured. Many parts of the business have been shut or spun off, and the remaining part is their aerospace business, which is effectively jet engines. And here they're the clear market leader. So about 3 out of every 4 commercial flights that take off worldwide are powered by a GE engine. And that represents a level of dominance that tells you something. Really, the only competitors are Rolls-Royce in a small part of the market in long-haul airlines, and Pratt and Whitney. There have been no new entrants for 50 years. Interestingly, the Chinese are trying to develop a competitor to Airbus and Boeing. That competitor used GE engines. The engineering prowess is absolutely extraordinary. You're talking about machines that operate at the cutting edge of physics. There's the obvious need for complete safety, complete reliability, very significant importance of fuel economy as well. So efficiency is absolutely key. And the business model is great as well. So interestingly, they don't actually make money or much money selling the engines. They sell them at more or less cost. But then for every engine that's in the global aircraft fleet, they get a 30-year plus recurring revenue stream from maintenance, repairs, spare parts. So this is terrific. We love recurring revenues. We love businesses that are predictable in nature. And effectively, every engine that they sell then provides a 30-year annuity that grows over time, normally above inflation as well. So another good example of a business that exists almost without competition, which is critically important. We got in at a very good price. We got in when it was still part of the GE conglomerate, and I think the exceptional quality of this business was somewhat concealed from most of the market. It's done very, very well since. We're conscious at the moment that the valuation has become quite rich. And whilst, I think we can objectively say that this is a terrific business, we can also objectively say that doesn't mean it's worth anything. There comes a limit to the valuation, and we will, play with position sizes, etc., when that becomes the case. Slightly different area, so more in the value camp. We've recently bought some shares in Tesco, which again everyone will know. I think Tesco is actually in a very, very strong position. So they've got about 28% market share in the UK, so almost twice the next largest, which is Sainsbury's. What's sort of interesting in the UK grocery market at the moment is that you have a couple of very clear shared owners. So both Asda and Morrison's are under private equity ownership, quite indebted, and consistently losing share, and do not have the cash flows to either reduce prices or invest in their store base. So you've got good shared owners. Previously in the UK market, Aldi and Lidl have been quite disruptive, but their share gains seem to have capped out, which means that Tesco is actually in quite a nice position. Great cash cow. When we bought it, the historical free cash flow yield was about 8%. It's obviously not a cyclical business. It's good and defensive. There's a shift towards people eating more at home at the moment. For a long time, people were eating more food away from home, but because of inflation recently, it's become very, very costly to eat out. So you're seeing that reverse slightly. And then because of share gains, they're actually putting up some decent growth numbers at the moment. So you get a good sort of 8% free cash flow yield, which is all returned to you, half dividend, half buybacks, plus some decent growth, reasonable multiple. We think this is a very sort of sensible place to have money right now. So there's a couple of examples. GE from the very, very high quality growth end of the spectrum. Tesco more in the sort of value camp, but with some growth. I think both outstanding equity investments. And the one common approach is we're focused on the long term, the competitive positioning, and we're focused on the cash flow. That's the sort of one common thread that holds it all together. So with that, I won't dwell too much on here. I mean, just draw your eyes to the bottom left. That shows our top 10 holdings. So Microsoft, Visa, AutoTrader, Alphabet, which is the parent of Google, Taiwan Semi, Intercontinental Hotels, lovely business, UK listed, Bank of Ireland, great cash cow, Shell, great cash cow, Charles Schwab, US online discount broker, probably the closest proxy here would be something like Hargreaves Lansdown, and Aena, which I mentioned, which owns every airport in Spain, freehold. Again, a business basically with no competition. So with that, I will hand back to Ryan in the studio. Very happy to take any questions that you may have.
Hello. Sorry, it's taking a while for my video to fire back up there. Thank you very much for that, Julian. And we have had a couple of questions come in, which we'll go through, but just a quick reminder for everyone to use the Q&A function in the corner if you would like to ask anything else. Now, the first one that we've had come in, and this is often something we talk about, is your hybrid benchmark, that 30% in the UK. Can you go into a bit more detail about why you have got that hybrid benchmark, how that's affected performance of late with the UK doing a bit better in 2025, and then why investors are better served with a trust that has this sort of benchmark and allocation rather than going for a global trust and a UK trust separately?
Yeah, sure. I mean, we want to be a sort of one-stop shop. So the idea is that you can have, in your savings, just one trust. You can hold it for the long term. You can think about it on a sort of generational basis. And we will give you some exposure to global markets and to the sort of domestic market. Over the last 10 years, to be, entirely candid, and I think most people know this, the UK market has underperformed global, primarily because of the significant outperformance of the US market. And if you look at a pure global benchmark these days, I think one thing people may not be aware of, but it's become overwhelmingly skewed to the US. So the US is probably about 2/3 of the benchmark. And then the US itself has become a very, very concentrated market. So the US has become very, I think the top five, this probably might not be current, but the top five S&P holdings were accounting for 25%, or was it even 30% of the entire S&P 500? So 500 stocks, but five account for well over a quarter of the total. So the US has become more like a very concentrated sort of tech fund, which has been fine. Doesn't mean it always will be. So I like the UK allocation because it's effectively a diversifier. So the UK market, as I mentioned, is generally more mature, so lower growth. We can certainly look back at the last 10 years and see that earnings per share in the UK market have grown less fast than they have in the US. But the dividends, the cash return, far, far higher. So very legitimate way of generating an equity return. And I would refer whoever asked the question to our 2024 annual report, where we talk about the reasons why the US over the last 10 years have outperformed the UK. That's a specific issue. And over the last 10 years, what you find is that the US grew earnings per share faster, but the dividends were much lower. But there were three factors that sort of boosted the US over the last 10 years. So there's first of all been the strength of the dollar. So for any UK listed investor, that's been a big tailwind. The big tax cut from Trump's first term, when US corporation tax was cut from one of the highest levels in the world to about 20% where it is today. So that was a big one-off. And then also the US market has got more expensive. So you've seen this one-off re-rating in the market. Whereas in the UK, you saw the market get cheaper. You didn't get a big tax cut. Um, the FX benefit wasn't there. And now today, a lot of those things are going into reverse. So, the dollar is weakening. There's a lot of concern about the dollar because of, these bills that Trump's trying to push through at the moment. Donald Trust, I heard his sort of nickname today. The US is a very expensive market relative to the UK. I mean, the multiple is literally twice as high. So it's a yawning gulp in valuation. And therefore, the starting point for the United States today is just a lot tougher than it is for the UK market. So in the trust, we want to have a combination. We want to have those outstanding quality US businesses. And let's be clear, some of them are amazing. Some of the world's best businesses are located in the United States. We don't want to not invest in them, but we also want to invest in sort of maybe more mature businesses that generate more cash, where you get your jam today. Also, a few concerns about the tech market in the US. The hype around AI is extraordinary. There are clear elements of froth in certain areas. We think, if you look at sort of Bitcoin, you look at Tesla, you look at the valuations of some AI concept stocks. There are reasons why you might want to be cautious about the US at the margin. And so some good old-fashioned cash cows are a reasonable place to be. And having that hybrid benchmark means that we have a bit more skew to those than a typical global trust would.
That's interesting. Thank you. As a question that's come up off the back of that, I think, which we'll combine together, is on the holdings that you've got in ASML and TSMC. Now, as you mentioned in the presentation, they are pretty much part of the same vertical, one sells and buys from the other. Having both of those in the portfolio, do you think there's a risk of sort of getting overexposure to one theme?
Yeah, I mean, together they're probably about 5% of the portfolio. We do generally like semiconductors as a space. I mean, it has been an area with structural growth that we think probably continues. I mean, the good reasons to think it does. The world is getting more computing intensive. Part of that's AI, but it's also everything from cars to industrials. So the general semiconductor intensity of the world is increasing. ASML and Taiwan Semi, I think, two of the best companies within the whole semiconductor ecosystem, although there are many others. Together at 5% of the portfolio, I don't think that's too much. It is something that we would like to back. The valuations for both those companies are, I think, surprisingly attractive given the barriers to entry and the structural growth. And the reason that is probably because they're very cyclical. So the history of semiconductors has always been one of sort of boom bust cycles, and that can be quite unnerving. I think if you own these companies, you just have to accept that that's there. But no, I think they certainly are correlated, and we'd probably be reluctant to put, say more than 10% of the portfolio in a sort of correlated set of risks like that. And we do want to make sure that we have a very diverse set of risks. But I think 5% to me feels comfortable.
Yeah, that's understandable. Thank you. Now, in your previous answer, you did mention the T word, that's Trump, who often sparks a lot of Q&A in our webinars.
Yeah.
How are you managing a global portfolio in a world of potential tariffs?
I mean, they're somewhat unavoidable. The direct impact on a lot of our holdings is surprisingly low. The number of companies that we have that sort of physically import into the United States is probably lower than you think. Where it does happen, most companies are in the same position. So what that means is that they will probably have to and probably be able to raise prices to compensate. So this is why people think ultimately tariffs are inflationary and therefore not a good thing. We did actually buy one company very much in the value camp recently, Kia Motors of South Korea. And we bought that sort of staring, down the barrel of tariffs. So Kia is a very successful automaker, probably the highest margin sort of automaker globally. make a lot of money in the States, where it's been a big success story, and quite a lot of those cars are physically exported from South Korea to the States. And as proposed, those tariffs will wipe out those profits. But we sort of felt it was in the price, exceptionally, low multiple equity with an incredibly strong balance sheet. So we have, in certain areas, decided to sort of take on that risk, thinking it's well digested. It'll be interesting to see how this pans out long term. I think most economists, most business people would caution against tariffs for very good reasons. So we'll see whether they stick. We're always bearing in mind, that Trump's only around for, another 3.5 years. It's very hard for a car manufacturer. A car manufacturer makes plans on a 10-year basis. So it's very hard for them to say, okay, Donald, we'll build another car factory here. Interestingly enough, actually, Kia Motors has just opened a very, very large plant in Savannah, Georgia, in the States, and they started planning for that plant in Trump's first term. That's how long it takes. Wow. So we have examples of companies in the portfolio that are exposed, but actually the vast majority of them don't have any direct impact. But we're very much in the camp that tariffs are not a good thing for the US, for the consumers there, for anybody.
Thank you very much. We've got a potentially slightly controversial question that's come in. Why do you think that AI, Bitcoin, and Tesla are just hype?
I don't think AI is hype, but we're focused on cash flow, as I mentioned, and I think ultimately all businesses value, all financial assets value, I think you can argue, stems from their ability to generate cash. Why do you hold them? Bitcoin very obviously generates no cash. You can put cash in the bank, you'll get interest. You can buy shares, they'll provide dividend. Actual assets. So Bitcoin to me, okay, you can own it if you want, but I'm not sure precisely what you think you have ownership of. I mean, I think all the Bitcoins in circulation are supposedly worth $2 trillion. For that you could buy the entire FTSE 100, you could receive $100 billion in cash and dividends per annum. As a sort of cash-focused investor, which I would argue all investors should be, that to me doesn't make sense. Tesla is, it's an automaker. That's where it makes its money. At the moment, their sales are going down. They've probably got the lowest margins in the entire group. It's a very, very tough business, autos, and it trades at a multiple well into the hundreds. Most automakers, if you look at Tesla, you look at Kia, it trades on a P of 2x cash. You look at BMW, it trades on a P of about 6, and Tesla trades at over 100. Okay, and so the entire value of Tesla comes from robo taxis. They've never made one, and humanoid robots. They've never made one. There's no reason to think that either of those businesses will belong solely to Tesla if they do take off. So that, matter of opinion, that's what makes a market. But we're centered on finding businesses that make money in the here and now. AI, I think, potential to change the world. I don't think anybody sensible would say AI is not going to have a profound impact. Nvidia today, monstrously profitable, but if you follow the money, AI is, Nvidia are ultimately selling to people who don't make much revenues. The use cases today for AI are still quite slim. The revenues are very, very low. So it's quite possible at some point we see a significant down cycle in sales at Nvidia. Nvidia is the one that we're torn by, though, because they do have an exceptional market position, and we are in the camp that AI will be very, very useful. We're just not quite sure ultimately how people will make money from it today.
Interesting. Thank you very much. Perhaps I've got a minute left, so I might try and squeeze the last two questions in if I may.
Yeah, of course, yeah.
One of them is just on the discount, which has it narrowed a lot and then sort of blew back out a bit. Just interested in your thoughts on sort of why that could be.
I think on the discount, I mean, it's very low. I don't know where we are exactly today. The last time I checked, it was about 1%. So there isn't much of a discount. I think we have a lot of sort of happy clients. We have a lot of wealth managers who buy us on a reasonably sort of programmatic basis. Good sort of long-term holders who don't particularly want to sell. There's decent demand for the shares. Yeah, that's why we think it is where it is. We don't have a management policy, so we don't do buybacks. So it's natural supply and demand. And at the moment, yeah, sort of trading more or less at asset value.
Great, thank you. And the last one, I'm going to combine a couple of questions. So there's one.
Sure.
Part one is, are you restricted by companies that are just in your benchmark, or can you pick off benchmark? And with that in mind, which region are you seeing the greatest value opportunities at the moment?
So yeah, we can go off benchmark. I mean, but bear in mind that the number of companies in our benchmark is vast. I mean, so most sort of listed companies of size will be in our benchmark. I can't remember. We have 55 holdings. We may have one or two that aren't actually in the benchmark. In terms of regional sort of exposure, I mean, the one sort of overweight tends to be Europe, where we find some really nice businesses trading at pretty palatable valuations. So that's been a bit of a benefit this calendar year. So if you look at our sort of weightings, that's where we have a bit of a overweight. It always comes from just bottom up, stock selection. But one of the great beauties of being a global investor is you can be extraordinarily selective, and you can make comparisons across regions. If we we talked about Tesco there, so I think Tesco at the moment's on about a P of about 13. Its closest proxy in the United States, Walmart, is trading on a P of well into the 30s. And we put these businesses side by side. We think Walmart's probably a stronger competitor than Tesco, but the actual sort of growth isn't that different. And today, Tesco trades up half the multiple. So, increasingly we're seeing sort of transatlantic divergences like that, which means that we're investing more on this side of the Atlantic. Banks would be another good example. So we have a couple of banks. They're both European, and by any metric, European banks seem to trade a significant discount to US banks. So whether you look at price to book, PE, look at the cash returns, European banks always are a little bit cheaper, for reasons that we can't really find. So, when we collectively make all the decisions for our equities like that, we end up with a portfolio that's currently overweight. Europe. I mentioned Kia recently. We've been looking at South Korea. I'm heading out there in a couple of months. Some interesting opportunities out there, we think.
Interesting indeed. Well, it does show the sort of wide variety of companies that you can pick from, and sort of the breadth of that portfolio for people that are looking for such a thing. Well, that does bring us to the end of the Q&A, and therefore the end of the presentation. So, Julian, thank you very much for your time, and thank you to all of our listeners for staying on board. The slides and a replay of this webinar will be available in the coming days on the KTI website. While you are there, you may also look at the most recent research note, which was written in the last few weeks, and that will go into more details on many of the aspects of the Brunner Trust. For more information on Brunner, you may also visit their company website, of which I believe the website is up on screen now, but if not, it will be very easy to find. That just leaves me to say thank you to all of you for the Q&A. It's been a great session, and we hope to see you again soon.